last week was a big week in terms of central bank meetings, and it could also be a kind of a really important signpost in terms of important events to clear. And I think all the events last week, including the Fed, including the Bank of Japan, kind of worked out in favor of risk sentiment, which is why we had such a strong rally last week. But this week, data is a bit lighter. The biggest data is core PCE. We're paying close attention to that, but it has been more better behaved compared with CPI. So we think that this narrative of immaculate disinflation has more room to run, which is why we continue to be pro-risk at this juncture. Everybody looked at the Fed keeping the 3 cuts for this year despite revising up inflation and growth. I think that's meaningful for near-term risk sentiment. They also revised up kind of their long-term rate forecast marginally, and I think that is them opening the door to acknowledging maybe neutral rate is higher. They don't want that to take center stage, which is why when Jay Powell was asked about it at the press conference, if rates are going to be higher for longer and higher in the longer term, he said, we don't know that. But I think they're trying to hedge their bets and opening the door for that higher neutral, which is what we're expecting as well.
So wait, what does that mean for treasuries? Are you still invested in treasuries? There was also a quirk with, for example, the price of gold that was at a record high.
Yes. So for treasuries, we prefer front end of the curve as well as belly of the curve. We do think that the long-term treasury market will have to battle with the higher term premium over time that will come. But for now, front end, belly of the curve, as rate cuts start, locking in a bit of that higher yield makes sense. But in the whole portfolio context, I would say, though, we are risk on, so equities look better than bonds. We're leaning more into equities than bonds at this juncture.